In this presentation, we're going to record the receipt of payment from a customer. In other words, we had an invoice in the past increasing the accounts receivable representing a customer owing us money. Now we're going to record that receipt of payment. Time to engage with Sage 50 Cloud Accounting. Here we are in our Get Great Guitars file. We're going to start off by looking at our reports. So if we go to the reports drop down, then we're going to go to our financial statements. We want to take a look at the balance sheet and the income statement. So I'm going to be opening up that balance sheet and then the income statement. So we'll say I want this for the current period or January, let's say January. And then I'm going to say okay. So there is our balance sheet, and then let's do the same for the income statement. So I'm going to go on down to the income statement. We're going to be opening that one up. Same dates. We're going to make this for January. So I'm going to make that for January and then say okay. And there we have that. That's what we got thus far. And then if I go on back to our objective, we're back in our Sage 50 primary area. We're in the customer and sales section now. So what we're going to do is we're going to go down in our flow chart. You'll recall last time this is going to be the typical flow that will happen in the full kind of service of the accounts receivable cycle or sales cycle. And that's going to be that we have the sales invoice, which we entered last time. That increases the accounts receivable, increases the revenue. Now we're going to say we're going to receive a payment. So this is going to be the second thing on the line here. Now, if you went to the invoices, note that if we go to the invoices and say I want to view and edit the sales invoices. So if I wanted to view and edit, then we could take a look at the invoices we currently have. I'm going to change the date up top so that we can see the current invoices. Let's just pick it up for the entire year this year. And that should give us, so there's the two invoices. Now we're going to be dealing with this one, Anderson. We're going to be receiving the payment on it. So I'm going to go ahead and close that, and that's going to be over here. So now let's think about what's going to happen with regards to the financial statements. Every time we enter a new form, I would first think, okay, what's going to happen with the financial statement, then make the form, and then think about the journal entry, and then actually go to the financial statement and do the kind of basically audit, going back from the financial statement to the source document. So if we go then to the balance sheet, what's going to happen? Well, we have something in accounts receivable now. People owe us money. And so now the accounts receivable is going to go down. The other side is going to be basically the checking account is increasing. Or we might want to put it into some other account like a holding type of account. Why would we want to do that? Because if we have multiple types of receipts, we need some way to group those receipts before we put them into the bank. So that when we put them into the bank, they'll be in the same grouping as they should show up on the check on the bank statement as in our books. So that's going to be another kind of thing we want to think about. Anytime we got a receive payment over here, the question is, if I put that directly into the bank, which we could do, is it going to be grouped in the same format on the deposit slips as is in the receive payment form? Or should we use some other method to allow us to group this together and then deposit it, such as possibly a clearing account, putting it into like basically the cash account maybe, and then transferring it to the bank in the same kind of format as we will see when we go to the actual bank. So that's what we'll actually do here. Now let's go ahead and record the receive money from the customer. So we're going to say receive money from the customer. We're going to say it's from Anderson. So I'm going to say Anderson. Actually, this is the ticket ID. I'm going to say 01 for the ticket ID, customer ID. Now Anderson. And so there is Anderson. Notice it popped back over to apply to the invoice. So it popped back over here and picked up our invoice. So now we're going to be applying it to this invoice. We can drill down on this invoice if we wanted to link to that. I'm going to go ahead and say pay. And as I link to the pay here, it'll apply the 5,000, actually populate that 5,000 up top in our form as well. So now we've got that as the payment amount. If we were to pay something lower than what was due, then of course we can put something lower and there would still be an outstanding balance on the form. So then we're going to say that it's going to be the date. The date we're going to make 011220, and the amount is the 5,000. I changed it so it deleted it, so the 5,000. We can have it as a check or some other kind of format. I'll keep it as the check. So let's keep it as the check. And then reference number, I'll put a reference number here. And the check number, I'll put a check number here. Now we have the option then to put it into the checking account. If it goes into the checking account, we want to make sure that we group it in the same way that it's going to show up on the bank statement. So one way, if we think it's going to be grouped differently, in other words, if I'm going to have multiple invoices I'm going to get together then go to the bank and deposit them as one lump sum, and it's going to then show on the bank statement as one lump sum. Then possibly I want to put it into like a clearing account, maybe the cash on hand account, which will represent money in this case that we would have that hasn't yet gone to the bank yet. So I'm going to try choosing the cash on hand and take a look at that method. So then I'm going to say save. Let's go save. And then yes, please. And then let's check out what happens. I'm going to close this back out and we're going to go on over to our financial statement. So we'll open up then the old balance sheet over here. And now we have the cash on hand at the 5,000, double clicking on that. There's our transaction, double clicking on that. Then we have our source document. So that looks good. Other side, closing this back out, closing this back out. It's going to be in the accounts receivable. If we go on into the accounts receivable, we're going to see the other side here, the 5,000 decrease for the Anderson going into the 5,000, and there is that transaction as well. So those are the two sides. Notice there's no effect, no change to the income statement because this was, even though we got cash, because it's coming out of one asset account, the AR, and going into the other asset account, that being the cash. So note then also we have this cash basically representing, in this case, on hand, the cash that we have on hand that we haven't put into the bank. We're going to go and transfer that to the bank, and we can imagine doing that basically at the end of the day, and then we'll transfer it from the cash on hand into the actual checking account. So that's going to be it for now. Let's get out of here.